Brian Sachs here with another Mortgage Minute. And one of the things that is so concerning to most people looking to buy a home is your credit score. There's so much misinformation out there in terms of how your scores are calculated and why it's different than what you might see in other places. But I wanted to share with you today a couple things. Number one, there are three ways of scoring credit. One method is for a credit card approval. One method is for an installment debt like a car or a school loan or a personal loan. And there's a completely different scoring model when it comes to a mortgage. And so if you're going to Experian or TransUnion or Equifax or getting your score in your credit card statement, it will be a different score than the score a mortgage lender is going to use. But what makes up your credit score? And here's where there is so much misinformation. One of the key issues with your credit score is your payment history, but it's only about a third of what makes up your credit score. So if you pay everything on time, that doesn't necessarily mean you're going to have a perfect credit score. It used to, but no longer. One of the big factors, another third, is your balance to your high credit. So the magic number we think is somewhere in the 20 to 30% range. And what that means is if you have a credit card with a $1,000 credit line, you should never, ever, ever let that balance exceed $200 or $300. A mistake many people use is they run it up to $1,000 and sometimes they pay it off with the next balance, with the next statement. That's wrong. Never, ever let the balance ever go above a third. That's 30% of your credit score. How long you've had credit is another 15%. So closing out old credit cards you don't use or store charges actually can hurt your credit score. The types of credit account for 10%. Do you have a good mix of installment debt, maybe a mortgage, some credit card debt, and new credit? You don't want to have too many credit card inquiries on your credit because that absolutely can hurt your credit score. So summing this all up, there are many factors that go into what your credit score is, not just how you pay and not just what your balance is. And so knowing this, you can come up with a formula where you have several different types of accounts, installment debt, revolving debt. You never let your revolving debt balance go above a third of the credit limit. And obviously you want to make sure you pay everything on time. So I hope this has been informative. I'll be back next week with another Mortgage Minute. Feel free to leave your comments and feel free to share this. And I'll talk to you soon.